Interest rate options are derivative contracts whose value depends on the future level of interest rates. These instruments are widely used by investors, corporations, and financial institutions to manage exposure to changing borrowing costs and interest rate risk. Common interest rate options include caps, floors, and swaptions. An interest rate cap protects borrowers against rising rates by establishing a maximum interest rate, while an interest rate floor protects lenders by establishing a minimum rate. Because interest rates influence the value of bonds, loans, and other fixed income instruments, interest rate options play an important role in hedging, risk management, and portfolio construction strategies. An interest rate cap consists of a series of individual call options on a reference interest rate, often called caplets. The buyer of a cap receives payments whenever the reference rate exceeds the specified strike rate. This structure limits borrowing costs while allowing the borrower to benefit if rates remain low. Conversely, an interest rate floor consists of a series of put options on the reference rate, known as floorlets. The buyer of a floor receives payments whenever market rates fall below the strike rate. Together, caps and floors allow market participants to customize their interest rate exposure according to specific financing and investment objectives. The value of interest rate options depends on several factors, including the current level of interest rates, the strike rate, time remaining until expiration, expected interest rate volatility, and prevailing discount rates. Higher volatility generally increases option value because greater uncertainty enhances the likelihood of favorable outcomes for option holders. Longer maturities also increase value by providing additional time for interest rates to move significantly. These relationships are similar to those observed in equity options, although the underlying variable is an interest rate rather than a stock price. Understanding these drivers is essential for effective option valuation and risk management. The Black-Scholes-Merton (BSM) model is one of the most influential option pricing frameworks in finance. The model provides a closed-form solution for valuing European-style options by incorporating variables such as the current asset price, strike price, risk-free interest rate, time to expiration, and volatility. Although originally developed for equity options, the model's underlying principles have been adapted for many other derivative markets. The BSM framework assumes frictionless markets, continuous trading, constant volatility, and log-normally distributed asset prices. Despite its simplifying assumptions, it remains a cornerstone of modern derivatives pricing and financial risk management. Swaptions are options that grant the holder the right, but not the obligation, to enter into an interest rate swap at a future date under predetermined terms. A payer swaption gives the holder the right to pay a fixed rate and receive a floating rate, while a receiver swaption provides the right to receive a fixed rate and pay a floating rate. Swaptions are valuable tools for managing future interest rate exposure and are widely used by financial institutions, asset managers, and corporate treasurers. Their valuation often relies on adaptations of the Black-Scholes-Merton framework and interest rate volatility assumptions. Option Greeks are sensitivity measures that quantify how an option's value responds to changes in key variables. Delta measures sensitivity to changes in the underlying asset price or interest rate. Gamma measures the rate of change in delta itself. Vega measures sensitivity to changes in volatility, theta captures the effect of time decay, and rho measures sensitivity to changes in interest rates. These risk measures help traders and portfolio managers understand the factors affecting option values. By monitoring Greeks, market participants can evaluate risk exposures and make informed adjustments to derivative positions as market conditions evolve. Dynamic hedging is a risk management strategy that involves continuously adjusting hedge positions to maintain a desired risk profile. Because option Greeks change as market conditions change, a hedge that is effective today may become inadequate tomorrow. Delta hedging is the most common form of dynamic hedging and involves adjusting holdings in the underlying asset to offset changes in option value. As delta changes over time due to movements in prices, volatility, or time to expiration, the hedge must be rebalanced. This process allows traders to manage risk actively and maintain more stable portfolio performance. Interest rate options, swaptions, the Black-Scholes-Merton model, and option Greeks form an integrated framework for understanding modern derivatives markets. Interest rate options and swaptions provide flexible tools for managing uncertainty surrounding future rates, while the BSM model offers a theoretical foundation for option valuation. Greeks translate complex pricing relationships into practical measures of risk exposure, enabling effective monitoring and control of derivative positions. Dynamic hedging complements these concepts by providing a systematic process for adjusting portfolios as market conditions evolve. Together, these topics are essential for pricing, hedging, and managing derivative instruments.